This is our Forex blog for August 4th, 2011, and like most days we really want to buy the strongest pairs versus the weakest. Clearly the dollar was, for the most part until about 7 o'clock here, consistently the strongest. The yen was extremely weak until about 6:30 when it became strong. So when the dollar was the strongest, you could have traded it against the yen, you could have traded it against the weak Australian, which if you notice is weak on all time frames. The CAD's weak on all time frames, and especially from 4:30 to about 7, it's extremely weak. And then after 10 here, you also have some weakness. I'm going to go over today also how to use these with the new range the range bars. So let's start with the dollar yen. We don't normally trade this because usually when one's strong, the other one's strong, and when one's weak, the other one's weak. Here's what a dollar yen chart looks like on the 5-minute chart, for instance. Strong dollar, weak yen, and it went up a considerable amount, 100 pips. You could put on a 6. Where do you get into this trend? If you didn't initially get into it at the beginning or on this nice little pullback right here, where do you get in on this ride on the way up? Range bars do a wonderful job of helping you answer that question of specifically when to get in and when to get out with the least amount of risk. Notice as this was going up last night how much clearer the 6 pip bar is than the 5-minute chart. When it first broke out, this was your first pullback, very low risk, 7 or 8 pips stop. You're in this trade somewhere as soon as it goes a pip above the bar's high after a pullback. You're in at 72, and even if you got out when it broke that low right here at 97, you made 25 pips. And you have the same exact pattern right here. You buy this pullback, it kind of goes sideways. Maybe even at the worst case scenario, you get out of half your trade here and the other half here when it went sideways. And after you're out of that trade, maybe you bought this pullback here. It's kind of going up, down, up. Maybe you got out of that trade right here, and you would have had to get right back in it. Basically there's so many different ways of getting in and out, and you can also use the parabolic stop. Parabolic stop looks very good on range bars, and you can use that for your entry and exit, small profit, 25 pip profit, 10 pip loss, and the last one you're in around 30 and you got out up at 75, so you made 45 pips on that last one. And if you think it went up statistically too much, you can go short and use that to catch a huge counter trend trade. Another thing you can do is use the regular chandelier stop, which the chandelier stop's interesting because it takes the high minus low over the last 7 bars in this instance and times it by 3. So because this is a 6 pip stop, it's basically trailing it by 18 pips. That may be too much for you. You may want to trail it by 12 pips. So you could change that to a 2, since each bar is 6 pips, and then you have a nice, also entry and exit. You're trailing the stop by 12 pips. See that? And when it breaks out, it has to close below it to stop it out. You can see it hit this area here, but didn't close underneath it, and kept you in that trade all the way up there for that 50 pip ride. There's so many different options that you have. So that was one of the pairs that was very likely to trend last night. The Australian was also weak, not quite as weak as the yen. So you could have also sold the weak Australian against the dollar. Last night, it was kind of chopping around here, made new lows, use that to get out. This wasn't really much of a pullback. If you wait for a deeper pullback, if you sell it right near the lows, it's a lot more likely to stop you out. But if you wait for a decent pullback, you're much more likely to make money. You can see this pullback here was 25 pips, and then you went short, and it kept you in there from 38 all the way down to 74. So you made about 60 pips on that last trade. Currency meter helps you find the currencies to trade, and the range bar does an excellent job of keeping you into it. And let's say let's look at the euro dollar. Now the euro was also mildly strong, so it's very likely to be choppy when you have two currencies together. But let's look at it on the 6 pip chart. If you're going to scalp the euro dollar, if that's your favorite pair, and it is likely to be choppy because they're both strong at the same time. Let's look at this starting the day off. You can see it was trending down, so mainly you want to sell a currency that's weak. You still have some nice little 20 pip moves right here. And when it breaks the trend line of the downtrend, whoops, sorry about that, the wrong one. Control R brings up the trend line tool. When it breaks that trend line, which I didn't draw perfectly on here, it's likely to have a reversal. So you can use that to trade the way up, and it made a higher high than this last high right here. So and the trend's up at that point. So you might get into that trade. And on the pullback right here, it broke this low, so that's a sign of weakness. Even if you didn't get into it right there, it kind of chopped around right here. You could either have sold that low right here or sold, the trend line break. And a lot of times, whenever you have a big move, you get 2 or 3 or 4 bar pullback. The first bar that goes green in the direction of the trend, you'd buy. And on this weak trade right here, you have a 2 bar up move with 1 bar closing down. You go short with your stop right above the high. It's a very easy, almost impossible method of screwing up. It doesn't work 100% of the time. Nothing does. But the point is, when it does work after a strong trend, it gets you into that trade at a reasonable point with a minimal amount of risk. Now, the Swiss also was strong across the board today. So, when the euro got really weak here at 8 to 10:30, the euro Swiss would have been an excellent one to look for sells in. Let's scroll back to 8:30 or so. Basically, if one currency is weak and the other one's strong, just draw your trend lines underneath there. That's a nice little 30 pip move. Same thing there. You can clearly see patterns that look like the market's not going down anymore. When it came up here, it didn't break these lows. You go short again here. That one only, fell 10-15 pips. And notice, it's not breaking the highs. If you got into a few trades and got chopped up, you can always just wait for the low to get broken, and you can see it fell from 25. Even if you got out of it right here, you just made 65 pips there. And the Euro Swiss, I believe, moves about 194 pips a day. So, a rule of thumb is you might want to take the average daily range of a currency and divide it by 10 or 15. If you divided this one by 10, you might have 20 pips per bar chart, which takes a lot of the noise out of the market. You can clearly see it's in a downtrend, right? And it's slightly, this high right here was a little bit higher than this one. It hit that trend line right there, and you might have gone short right here. Or you don't know a trend line is really valid until it hits at least twice, so it's not really in effect until that point. But on every pullback, you could go short the 20 pip bar. In this case, you add 2 or 3 pips to the outside, and you're risking a little bit more pips, so you'd have to trade smaller lot sizes. But this one moves a lot more. This last move down from 17 just pretty much continued. Even if you got out of the trade right here when it started going back up at 14, you almost made 100 pips, while risking 25. So, even if you added 5 pips to the outside of the high or low. If you short, you had to stop 5 pips above the high, for instance, and so forth. There's just a lot of different ways of trading with this. The Australian also was extremely weak, and probably more so than the euro. So the Australian Swiss would have been an excellent one. This one's also probably pretty volatile, so 20 or 15 pips per bar most likely would be a good, you can see it fell 100, 200 something pips. And by looking at the 20 pip bar, you see these beautiful entries. You might have gotten short right here, you would have had a loss. You got in short again right here. Let's see at 82.23, and it fell 140 pips. So you might have lost 10 to 25 pips on the first one and made 100 something pips on the other one. Currency meter clearly showed the Australian was the weakest throughout the day, and the Swiss was very strong on all time frames the majority of the day. Pretty much a no-brainer. And using the range bar versus, let's look at this on a 5-minute bar. It doesn't look nearly as clean. First of all, on a 5-minute chart, you can't see as far back, and you don't really know where the significant levels are. You have to zoom back out. This was in a big downtrend, went up, came down. It's clearly in a downtrend. You can't see that on a 5-minute chart. The only entry I think I would have taken on this one was this pullback right here. Probably none of the other patterns really look too good to me on a 5-minute chart. Whereas, on this chart, there's a few other trades. You might have gotten this little pullback right here. You see this consolidation area right here. You see that this was the low here, here, and here. And so if you didn't take that trade here, when it finally breaks underneath that support area, even if you got in 80 pips late, you still had a good chance to make 70 pips on the trade. So range-based bars, in my opinion, are the best, and you can have, you probably should have at least 2 up for each currency, a longer term one like this and a shorter term one for precise entries. If the trend's down, you can wait for a little bit of a pullback on the longer term one and use the shorter term one for even a more precise entry, where your stop might be 6 to 10 pips versus 20 or 25.